this point, I think it's probably pretty safe to say that if you're a dividend income focused investor, you've definitely had both JEPQ and QQQi come across your radar. And for good reason. Both of these investments, both these ETFs offer investors like you and I a massive amount of income potential with also some upside included. But in this video specifically, we're going to dig a little bit deeper into both JEPQ and QQQi and try and figure out not only which of these ETFs is a better fit for you and I, but also which of these two ETFs will make us richer long term. So if you're a dividend income focused investor looking to get your dividend income up as fast as possible in a safe manner, make sure to stick around, drop a like down below, and let's get right into it. Real quick, for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook, where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the market. Along with the ebook, you're also going to receive my custom dividend tracker, where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. Now, I had to make a video about both QQQi and JEPQ because I came across this amazing article from Macro Tips Trading on Seeking Alpha, where they broke down the differences, the similarities, and went through both these ETFs in detail. And it was just too good to pass up. I have got to share this with you guys. So first off, the summary says the NEOS Nasdaq 100 High Income ETF, or QQQi, is a buy right active ETF that utilizes a proprietary data-driven call option strategy on the Nasdaq 100 index. Now, this ETF pays an attractive 14.5% annualized distribution yield while delivering a strong 12.5% total return, and this is since inception. Keep in mind this ETF has not been trading all that long. Now, QQQi's flexibility is a valuable real option, especially after sharp market declines, when selling call options can help with fund returns. They then said we are increasingly seeing investment managers launch short volatility structured products that combine investments in equity indices like the Nasdaq 100 index with a derivative overlay to generate option income. In March, Bloomberg estimated that over $60 billion was invested in these type of strategies. And honestly, that doesn't surprise me whatsoever. These sort of strategies, although they have been around for quite a while now, are still popping up like crazy and getting a ton of investors involved. They then said one of the newer funds in the space is none other than QQQi. Similar to its sibling fund, we're talking about SPYI. QQQi's mandate allows the fund manager to have the flexibility in varying the notional overwritten and choosing to write call spreads instead of calls. This flexibility can be very valuable, especially after sharp market declines. Now, overall, this new ETF has delivered total returns in line with the buy-rated JEPQ ETF. The choice between QQQi and JEPQ may come down to an investor's preference for income or capital gains. I rate QQQi, though, as a buy. Now, looking a little bit deeper into the QQQi strategy, they said similar to SPYI, this ETF invests in the stocks that make up the Nasdaq 100 index, plus a call option strategy that involves a mix of both written call options and long call options, i.e. writing call spreads. Furthermore, by utilizing the NDX index options that are classified as Section 1256, this ETF may receive favorable tax treatment as Section 1256 contracts are taxed at 60% long-term and 40% short-term capital gains. Now, as per the mandate, this ETF holds the stocks in the Nasdaq 100 in addition to writing call options. As of early July, the ETF has written call options on NDX index with a strike price, for example, of 20,500 and 20,200, expiring August 16th, for example. Now, contrary to the strategy description above, this ETF does not hold any long call options, at least as of this. Now, with the Nasdaq 100 index currently sitting at around 20,400, it appears that the QQQi has written options that are slightly in the money, or ITM, and also out of the money. The QQQi has written 124 option contracts in total, worth around $254 million in notional value. So this means that this fund has overwritten around 76% of the notional of the fund. Now, since inception, this ETF has seen about 12.5% total return, and this is compared to 17% total return if we're looking at the Q. Now, comparing QQQi to some of its peers like JEPQ, like QYLD, etc., they said the difference in the total return performance between QQQi and JEPQ and QYLD can be attributed to subtle differences in their strategies. First, comparing QQQi to JEPQ, we know that JEPQ overwrites 100% of its portfolio and mainly uses slightly out of the money calls. On the other hand, the amount of notional overwritten by the QQQi is at the management's discretion. Now, after comparing total returns, Figure 6 compares the distribution yields of the three funds, and this is talking about the QQQi, QYLD, and JEPQ. Based on the most recent month's distribution analyzed, QQQi is yielding around 14.5%. Now overall, QQQi and JEPQ are clearly superior to that of QLD, and I think we all know that, in terms of total return. However, selecting between QQQi and JEPQ may be up to the investor's personal preference between receiving returns as monthly income or possibly unannualized future capital gains. Now looking into the capped upside and uncapped downside is the main risk for QQQi. Because while this ETF has delivered solid historical returns so far, one issue could be downside exposure later on. The main weakness of the buy rate strategy is that the upside returns are capped by the call option sold, but downside returns are not capped. During violent sell-offs, the QQQi ETF may decline nearly as much as the underlying index. Although to date we have not seen such a drawdown, at least not of this is just not as of yet, it is almost inevitable to see QQQi ETF experience a large drawdown sometime in the future. Now lastly, the conclusion. Following on the success of SPY ETF, which is one of my favorites, the NEOS NASDAQ 100 High Income ETF is a new entrant in the buy right ETF space, focusing on the NASDAQ 100 index. This ETF invests in a portfolio that replicates the NASDAQ 100 index plus a data-driven call option strategy that may buy and sell call options to generate income and hopefully see a little bit of upside also. They said, I believe this ETF's flexibility in writing covered call spreads on varying notional exposure can be very valuable, especially after sharp market declines when writing calls can lead to underperformance. So far, this ETF appears to be a solid income fund, paying around 14.5% annualized distribution yield, with total returns around 12.5% since inception. And overall, lastly, they said, I believe that this ETF deserves a strong buy for investors seeking income for a growth portfolio. The choice between this one and JEPQ is up to the investor's preference, whether or not if they want to see more income from day one, or conversely, if they want to see more possible capital appreciation, some more capital gains later on, JEPQ could be a better option potentially. Now, for me personally, I own a lot more JEPQ than I currently own of QQQi. And that's exactly because of what the writer was saying. JEPQ, in my opinion, and because the way the strategy works, has a little bit more upside potentially, at least up until so far. But on top of that, JEPQ does pay a pretty decent dividend yield to go along with it. So a lot of covered call ETFs have an underlying focus that they sort of track or reference to, or of course invest directly into. QQQi is focusing on the NASDAQ 100 and using that index to sell covered calls on, which isn't really groundbreaking or anything that crazy, but just wait, it gets better. So it says number 2, actively managed by NEOS. The fund seeks to take advantage of tax loss harvesting opportunities in addition to utilizing NDX index options classified as Section 1256 contracts, which are subject to lower 60/40 tax rates. So what I've found great about NEOS overall since I sort of came across NEOS a while back, at least with SPYI and now QQQi, they're really trying to take a different angle, a different approach, and trying to make some of these more income-focused, covered call style focused ETFs a little bit more tax efficient, which by utilizing 1256 contracts, this ETF could have a much better tax treatment than some other similar funds out there that have a similar strategy that QQQi has. So far it seems pretty straightforward and pretty positive. By utilizing the NASDAQ 100 and implementing a data-driven cover call strategy, also along with that being very tax conscious, and of course trying to get this ETF to be the most tax efficient as possible, so far so good. But now lastly, most importantly, I want to hear from you guys down below. If I were to ask you to choose between QQQi, the NEOS NASDAQ 100 High Income ETF, or the popular JEPQ JP Morgan NASDAQ Equity Premium Income ETF, which one would you choose and why? Let us know in the comments down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.